A perfect setup appears on your screen. Every criterion met. Clean structure, strong volume, ideal risk-reward. This is exactly what your strategy identifies as high probability. You should take this trade. But you don't. Not yet. You need to check one more thing. Let me look at the 15-minute chart. Let me verify the volume calculation. Let me check if there's any news. Let me see what the broader market is doing. Let me review my rules one more time to make absolutely certain. 5 minutes pass. The setup is evolving. The entry point you identified is gone. The risk-reward has deteriorated. Now you're facing a dilemma. Chase it at a worse price or let it go? You let it go. You tell yourself you'll wait for the next one. The trade goes straight to target. You would have made $620. Instead, you made nothing because you thought your way out of a trade your strategy said to take. This pattern repeats constantly. Your best opportunities, the setups that meet all your criteria, are the ones you overthink until they're gone. You're not missing opportunities due to poor analysis. You're missing them because your analysis never ends. And until you understand why your brain enters infinite analysis loops and how to build decision-making systems that prevent overthinking paralysis, you'll keep watching your best trades happen without you. The psychology of overthinking in trading. Here's what's actually happening when overthinking causes you to miss opportunities and why more analysis creates worse decisions. Overthinking, in psychological terms, is the continuation of analysis beyond the point where additional information improves decision quality. You've gathered sufficient information to make a sound decision, but instead of acting, you continue analyzing, searching for certainty that doesn't exist. This occurs because your brain confuses analysis with preparation and thinking with progress. Your prefrontal cortex, the analytical brain region, provides comfort through continued thinking. As long as you're analyzing, you feel like you're doing something productive, avoiding the discomfort of commitment and risk. Psychological Mechanism 1. Analysis as anxiety management. Overthinking isn't actually about improving decisions, it's about managing anxiety. When facing an uncertain outcome like a trade, your brain experiences anxiety. Analysis temporarily reduces this anxiety by creating the illusion of control. If I just check one more indicator, I'll be more certain. If I just verify one more time frame, I'll be more confident. This feeling is false. The additional analysis rarely adds meaningful information, but it provides temporary anxiety relief, so your brain keeps seeking it. The problem, while you're analyzing to manage anxiety, the opportunity disappears. You've traded real opportunity for false certainty. Psychological Mechanism 2. Perfectionism and decision paralysis. Many traders unconsciously believe that with enough analysis, they can identify trades with near certainty. This perfectionist thinking creates impossible standards. I need to be more sure before I can act. But trading is probabilistic. No amount of analysis converts probability into certainty. Seeking perfect confidence before acting guarantees you'll never act because perfect confidence in uncertain outcomes is impossible. This creates decision paralysis. You're waiting for a confidence level that can never arrive, so you remain frozen in perpetual analysis. Psychological Mechanism 3. Fear of commitment disguised as diligence. Overthinking allows you to avoid the psychological discomfort of commitment. As long as you're still analyzing, you haven't committed capital, haven't accepted risk, and can't be wrong yet. Your brain presents this avoidance as being thorough or being careful, making overthinking feel like responsible trading, but it's actually fear of commitment disguised as analytical rigor. The 4 types of trading overthinking. Different overthinking patterns destroy opportunities in distinct ways. Type 1. Infinite verification loops. You check your criteria. Trade meets them, but you check again, then again from a different angle, then verify your verification. You're stuck in a loop where no amount of confirmation feels sufficient. Your internal dialogue. It meets the criteria, but let me double check. Okay, still meets them, but let me verify I'm reading the chart correctly. Maybe check the daily chart too, and let me recalculate the risk one more time just to be absolutely certain. Type 2. Scenario catastrophizing. You identify a valid trade, but immediately begin imagining all possible negative outcomes. What if there's unexpected news? What if this is a trap? What if market conditions shift? What if this is the one trade that fails spectacularly? This catastrophizing generates endless what-if scenarios that feel like important risk assessment but are actually just anxiety spiraling that prevents action. Your internal dialogue. This looks good, but what if it gaps down overnight? What if there's a sector rotation I'm not seeing? What if institutional sellers are waiting to dump at this level? What if this is actually a bull trap? Type 3. Information addiction. You need one more data point, one more indicator, one more time frame, one more opinion, one more piece of information before you can decide. But each new piece generates questions requiring more information. This creates infinite information gathering where decision-making is perpetually postponed because there's always potentially more information to consider. Your internal dialogue. Let me check the volume profile. Now let me check institutional holdings. Now let me see if there's any options activity. Now let me check what happened last time price was at this level. Now let me check sector performance. Type 4. False comparison analysis. You identify a good setup but immediately start comparing it to other potential setups, other time frames, other instruments. But what if there's a better opportunity somewhere else? What if I take this and miss something better? This comparative analysis makes every opportunity feel insufficient because there might be something better, creating paralysis where you take nothing because you're waiting for the best option that never clearly emerges. Your internal dialogue. This is good, but let me check my other watch list stocks. Maybe one of them has a better setup. Let me compare the risk-reward ratios. Let me see which has better volume, which one is really the best opportunity here. Meet Yale, the trader who analyzed his way to failure. Yale had been trading for 6 years when he discovered that his analytical ability was actually destroying his results. He was skilled at identifying setups. His strategy was sound. His problem was that he analyzed himself out of his best opportunities. Yale implemented tracking for opportunity capture rate. For every setup that fully met his criteria, he documented whether he took it or missed it and why. Over 4 months, the data was devastating. Perfect setups identified, 84 setups meeting all criteria. Perfect setups taken, 29, 35% capture rate. Perfect setups missed, 55, 65% miss rate. Why setups were missed? Overthinking or additional analysis, 38 setups, 69%. Hesitation or couldn't pull trigger, 12 setups, 22%. Distraction or missed timing, 5 setups, 9%. Performance analysis, 29 taken setups, win rate 72%, average profit $430. 55 missed setups tracked, 38 went to target, would have won, 17 would have stopped out. Missed opportunities cost around $11,400 in foregone profit. Yale's overthinking was cutting his opportunity capture rate to 1/3. He was identifying the right trades, but thinking himself out of 2/3 of them. His analysis was excellent. His execution of that analysis was catastrophic. Inside Yale's mind, Overthinking an opportunity away. Yale documented his internal dialogue during a typical overthinking episode. The perfect setup appears. Wednesday, 10:47 a.m. Yale spotted a breakout setup. He ran through his checklist. Price breaking resistance, check. Volume 2.1x average, check. Higher time frame trend aligned, check. Risk reward 3.2 to 1, check. All confirmations present, check. His analysis concluded, this is a perfect setup. Take this trade. Entry $56.30, stop $55.85, target $57.85. Yale's hand moved toward his keyboard, but before executing, his brain generated doubt. The overthinking spiral begins. Wait, this looks almost too perfect. When setups look this obvious, they sometimes fail. Let me just verify the volume calculation. 2.1x average. Let me recalculate that. Okay, yes, 2.1x. But is that 2.1x the 20-day average or the 50-day average? Let me check both. Yale recalculated using 50-day average, 1.9x. Slightly lower than using 20-day, which is the right average to use. My rules say 1.5x minimum, so either way it qualifies, but Yale was already overthinking. The setup still met his criteria, but he'd found a microscopic uncertainty to fixate on. The verification loop. Okay, volume is fine either way, but let me just double-check the resistance level. Is $56.20 the real resistance, or should it be $56.35? Let me zoom out. Let me check the daily chart. Let me verify my resistance line is drawn correctly. Yale spent 3 minutes reanalyzing resistance. His original identification was correct, but overthinking required re-verification. Resistance is at $56.20. Price is at $56.30, so we're 10 cents above. That's a valid breakout. But is 10 cents enough? Should I wait for it to close 15 or 20 cents above resistance? What's the right amount of clearance? Yale's rules didn't specify clearance amount. His rules said price above resistance with confirmation. This qualified, but overthinking was generating new requirements that didn't exist in his strategy. The information addiction. Let me check one more thing. What's the broader market doing? Let me check the index. Okay, market is up. That's supportive. But let me check the sector. How's the sector performing? Sector is mixed. Is mixed sector performance a concern? Should I only take trades when sector is strongly up? By now, Yale had been analyzing for 4 minutes. Price had moved to $56.45. His planned entry at $56.30 was 40 cents away. The risk-reward had deteriorated from 3.2 to 1 to 2.4 to 1. The false comparison. Wait, let me check my other watch list stocks. Maybe one of them has a better setup. Let me scan through them. This one looks interesting too, and this one. Now, which one is really the best opportunity? Should I compare all 3 setups and take the single best one? Yale was now analyzing 3 setups when he'd already identified one that met all his criteria. Comparison was creating paralysis. The opportunity evaporated. By the time Yale finished comparing, 8 minutes had passed. Price was at $56.70. His original entry at $56.30 was 40 cents away. The risk-reward was now 1.8 to 1, below his 2.5 to 1 minimum. Well, it's moved too far now. I can't chase it. I missed this one. I'll wait for the next setup. That's the disciplined thing to do. Yale didn't take the trade, not because it was bad, because he overthought it until the opportunity passed. The painful observation. Over the next 2 hours, Yale watched price move cleanly to his original target of $57.85. His planned trade would have made $620. His overthinking cost him the entire opportunity. Why do I do this? The setup was perfect. I knew it was perfect, but I had to check one more thing, then another, then another. By the time I finished thinking, the opportunity was gone. I analyzed my way out of a great trade.
The anatomy of overthinking destruction. Yale identified how overthinking destroyed his trading. Destruction pattern 1. Optimal entry point loss. Overthinking consumed critical time. During that time, optimal entry prices disappeared. By the time analysis finished, entries had deteriorated, forcing either worse trades or missed opportunities entirely. Yale's average overthinking duration, 6.5 minutes. In that time, perfect entries became mediocre entries or no entries. Destruction pattern 2, false complexity addition. Overthinking generated requirements that didn't exist in Yale's strategy. Should I check this? Should I verify that? These weren't strategy requirements, they were anxiety management disguised as thoroughness. This false complexity made simple, valid setups feel insufficient, causing Yale to pass on trades his strategy said to take. Destruction pattern 3, confidence paradox. More analysis didn't create more confidence, it created more doubt. Each additional check revealed minor uncertainties that fed more overthinking. The more Yale analyzed, the less confident he felt. This confidence paradox meant overthinking achieved the opposite of its intention. Instead of increasing certainty, it increased doubt. Destruction pattern 4, decision fatigue accumulation. Each overthinking episode depleted Yale's decision-making energy. By the time he'd overanalyzed the first setup, he had less mental energy for subsequent opportunities, causing more overthinking or complete paralysis. This created accelerating decline. First setup overthought moderately, second setup overthought severely, third setup completely missed due to fatigue. Yale's transformation. Building decisive execution. Yale built systems that prevented overthinking by creating decision boundaries and time constraints. System 1, the 90-second rule. Yale implemented absolute time limit. From setup identification to entry decision must occur within 90 seconds. Not 90 seconds of thinking, 90 seconds total. This forced decisive analysis. Yale completed his checklist quickly, made his decision, and executed. No time for infinite verification, no room for catastrophizing, no opportunity for information addiction. System 2, single-pass checklist. Yale converted his strategy into a binary checklist with specific items. Each item was checked once, no rechecking, no re-verification, one pass through the checklist, decision made. Checklist items required yes-no answers. Does price show breakout? Yes-no. Is volume above 1.5x? Yes-no. Is trend aligned? Yes-no. Is risk-reward above 2.5 to 1? Yes-no. All yes? Take trade. Any no? Skip trade. One evaluation, one decision. System 3, pre-decision commitment. Before analyzing any setup, Yale wrote, "If this setup meets all criteria on first analysis, I will take it immediately without additional verification." This pre-commitment removed the option to reanalyze. Yale committed to his first analytical pass, trusting his strategy and his initial assessment. System 4, information diet. Yale created a strict information boundary. Only information directly specified in his strategy criteria could be considered. Anything else was noise. If his strategy didn't require checking sector performance, he didn't check it. If it didn't require scanning other stocks for comparison, he didn't do it. This eliminated information addiction. System 5, doubt acknowledgement without action. Yale stopped trying to eliminate doubt through more analysis. Instead, he acknowledged doubt, then acted on his checklist regardless. I'm feeling doubt. That's normal. My checklist says this trade qualifies. Taking it despite doubt. Doubt became information to observe, not a problem requiring more analysis. System 6, opportunity tracking accountability. Yale tracked every setup meeting his criteria, noting whether taken or missed. This accountability made overthinking visible. Seeing missed due to overthinking appear repeatedly in his journal created motivation to fix the pattern. The breakthrough realization. 6 months into his transformation, Yale identified a perfect setup. His old pattern would have been to verify, recheck, compare, and ultimately overthink until it passed. But Yale had a profound insight. More analysis won't make this trade more certain. It will only make me miss it. My strategy says, take this. That's the only information that matters. Thinking more won't improve my decision. It will just waste my opportunity. I can feel the urge to verify one more thing, but that urge is anxiety, not analytical necessity. I'm taking this trade now. Yale executed within 45 seconds of identifying the setup. No re-verification, no catastrophizing, no information addiction, just strategy recognition and execution. The trade worked, but even if it hadn't, Yale felt proud because he'd executed his strategy rather than overthinking his way out of it.
Yale's results, the transformation in numbers. Before anti-overthinking systems, perfect setups identified, 84. Perfect setups taken, 29, a 35% capture rate. Missed opportunities, 55. Foregone profit from overthinking, $19,400. After anti-overthinking systems, perfect setups identified, 91. Perfect setups taken, 82, a 90% capture rate. Missed opportunities, 9. Actual profit from high capture rate, $18,700. Time from setup identification to decision, average 68 seconds. Yale went from capturing 1/3 of his opportunities to capturing 9/10. His overthinking had been costing him approximately $11,000 in missed opportunities. After implementing decisive execution systems, he captured almost all valid setups.
How to stop overthinking. Your action plan. Step 1. Track your opportunity capture rate. For the next 30 setups that meet your criteria, document whether you took them or missed them. Calculate your capture rate. Below 70% indicates overthinking problem. Step 2. Identify your overthinking pattern. Which type describes you? Infinite verification? Catastrophizing? Information addiction? Comparison paralysis? Name your specific pattern. Step 3. Implement time limits. Create absolute rule. 90 seconds from setup identification to entry decision. Use timer. This prevents infinite analysis loops. Step 4. Build binary checklist. Convert your strategy to yes/no questions. One pass-through checklist. All yeses, take trade. Any no's, skip trade. No rechecking allowed. Step 5. Set information boundaries. List only the information your strategy requires. Everything else is prohibited. This stops information addiction. Step 6. Pre-commit to first analysis. Before analyzing setups, commit. If this meets criteria on first pass, I take it immediately. Remove the option to reanalyze. Step 7. Separate doubt from decision. Practice. I feel doubt. I'm taking the trade anyway because my checklist says so. Doubt becomes observation, not decision input. Step 8. Create overthinking accountability. Track every instance of overthinking causing missed opportunities. Make the cost visible in your journal. Use shame of pattern to motivate change.
The fundamental truth about analysis and decision-making. Here's what Yale learned. There's an optimal amount of analysis for trading decisions. Less than optimal means insufficient information. More than optimal means paralysis. Most traders think more analysis always helps. It doesn't. Analysis has diminishing returns than negative returns. The first 90 seconds of analysis provide most value. The next 5 minutes add little. The next 30 minutes actively harm decision quality by generating false complexity and anxiety. Your strategy defines what information matters. Anything beyond that isn't thoroughness, it's overthinking disguised as diligence. Trust your strategy, trust your initial analysis, execute decisively. The best opportunities require quick recognition and fast execution. While you're overthinking, decisive traders are capturing the opportunities you identified first. Stop analyzing your way to perfect certainty that doesn't exist. Start executing on sufficient probability that does exist. Your overthinking isn't protecting you, it's costing you. Build the systems that prevent it.